Hello, everyone, and happy Wednesday to you. Hope you're having an incredible day. Welcome to SRT Live with me, Sean Richard, your host here at Guaranteed Rate and the Sean Richard Mortgage team. Thanks so much for joining me today. So, hope you're having an incredible week. We've got a lot of good data to come out or a lot of good data to go over today. Last week we had some key data come out. We get some weekly information, such as like jobless claims. We're going to touch on those. We're also going to look ahead to later this week. We've got jobless claims coming up again tomorrow. And then on Friday, last Friday, we had the big Board of Labor and Statistics, BLS, jobs report. So we're going to talk about that as well. And then we'll look ahead to anything else coming up this week. So let's dive in. So looking at last week, we had jobless claims last Thursday. And so again, jobless claims, this is number of people filing for unemployment. There's two components. There's the initial jobless claims, and then there's the continuing jobless claims. Initial is the number of people filing for unemployment for the first time, and continuing jobless claims is those who are continuing or renewing their unemployment claims. So last week, the jobless claims that we got were for the prior week. So previously, we were at 200,000 new claims. The expectation for last Thursday's numbers were 197,000 new claims, and we got 207,000 new claims. So 10,000 more than expected, but we've got to take that with a little bit of a grain of salt because we're still sitting at extremely low levels. We're hovering in that just under and just over that $200,000 level, or I'm sorry, the 200,000 quantity level. And that's some of the lowest figures that we've seen post-pandemic. So initial claims continuing to stay relatively low. Now, continuing claims, this also is staying relatively low, but we did see a tick up in this as well. So the prior week, we had continuing claims at 1.718 million. The expectation for last Thursday was 1.688 million, and we did get a little bit more than that at 1.754. So a little bit higher number of people continuing to renew those unemployment claims. And so we'll have to keep an eye on that as we move forward to see if we continue to decline or if we start to grow. But right now, I think we are going, in my opinion, is we're going to continue to see those numbers stay low. If you're searching for a job, you know that there's a number of job openings. There's 10 to 12 million job openings in our country right now. And companies are struggling to find workers. So they're retaining their existing workers longer, and that's reflected in these jobless claims numbers. So that was the numbers from last Thursday. Now, the previous numbers of like 1.718 million on the continuing and that 200,000 on the initial. So that was for 2 weeks ago now. And so we are trending up a little bit, but we'll need to keep an eye on that. The big item last week was the jobs report. This is the BLS jobs report, the Board of Labor and Statistics jobs report, which measures job creations for the prior month. So the report that we got last Friday was for the month of December, and that came in at 199,000. Now, the market was expecting about 400,000 new jobs created in December. So that was a big miss. We missed by 50%. However, it doesn't hit as hard as you might think because October and November's numbers were revised higher by an aggregate of 141,000. So that offsets the bulk of the miss that we got from last Friday's numbers, which is why those numbers, the jobs report numbers, that big miss, didn't have a significant impact in the market. Normally, with a miss that big, we might see interest rates climb on that news, and we didn't see a whole lot of movement on that news. We did see a little bit of a climb, but not nearly as much as we otherwise would with that big of a miss. So that was extremely interesting. We're going to keep an eye on unemployment as we continue to go forward in this unique economic landscape that we have. The unemployment rate did tick down from 4.2 to 3.9, so that's dwindling, and we're seeing it get back down to pre-pandemic levels. Now, some additional information that we got last Friday was from Apartment List, and this was their rent report. And so this measures year over year rental increase percentages. And so year over year, Apartment List is reporting that rents increased by approximately 18% year over year. Now, with that being said, December actually declined by 0.2%. So month over month, we saw December decline by 0.2%. And that's a little bit to be expected, right? December is a slower month, not as many people signing new leases. Renewals don't always happen in December. You've got holiday seasons. So a little bit slower time in the real estate and rental market, and that could account for that decline in December. So it'll be really interesting to look at that number once we get January's figures to see where that comes in. And so we'll get those next month. All right. So today, big day also, we got inflation data. We got CPI, which is Consumer Price Index. And so Consumer Price Index is measuring consumer prices, price inflation at the consumer level. So we also get, like tomorrow, we get Producer Price Index. So Producer Price Index is inflation at the producer level, manufacturing, wholesale. And then today we got Consumer Price Index, so inflation at the consumer level. And so we get the month over month numbers as well as the year over year numbers. Month over month, the expectation is that we were going to see a 0.4% increase month over month. We actually got a 0.5% increase month over month. And so that pushed our annual year over year number up from 6.8 to 7.0% year over year inflation at the consumer level. Now, not to be too alarmed, but that was the expectation. That's what the market thought we were going to end up at 7% flat. And so since it was in line with market expectation, we didn't see any significant movement in the mortgage market because of that. Now, that being said, 7% is red hot inflation. This is actually some of the highest inflation that we've seen in almost 40 years. And so because of this, we're seeing the Fed take action. You know, we heard from Jerome Powell yesterday, and ultimately the sentiment out of the Fed is that they're going to need to act in order to try and curb inflation. And so the Fed's been talking about rate hikes in the federal funds rate. Now, quick aside, the federal funds rate is not prime rate, and it is not what directly drives mortgage rates. The federal funds rate is the overnight lending rate between banks. So if the Fed increases the federal funds rate, it doesn't have a direct impact on mortgage rates. It is indirect because it does impact the economy as a whole, and ultimately that trickles into many different tributaries of the core economy, but it doesn't have a direct impact. So the Fed's been talking about rate hikes in the Fed funds rate. Right now, they've got the Fed funds rate between 0 and 0.25. They're looking at possibly raising that. And there's reason to believe that we could see upwards of 3 to 4 Fed rate hikes to help curb inflation and bring that back down. And let's rewind a little bit, because last year, the Fed was talking about trying to maintain inflation around 2%. And here we are upwards of 7%. Wages are rising, but they're having trouble keeping up with overall inflation. So, you may have gotten that 3% raise at work, but when you go to the grocery store and you pay, 5, 6, 7, 10% more for the groceries that you're buying, it still hits the pocketbook, the wallet a little bit harder. So inflation red hot right now, and inflation is the enemy of mortgage rates. So if we continue to see inflation rise, we're highly likely to continue to see mortgage rates rise in the coming months. And the Fed's going to try and counteract some of that to curb inflation with those rate hikes. So we want to keep an eye on that. The anticipated first Fed rate hike is looking like March. And then how quickly they continue to hike after that is going to be dependent on what reaction we get in the marketplace based on those rate hikes. But it does take time for those to trickle down and have an impact in the market. Now, tomorrow we do get producer price index, not something that's necessarily I'm going to report on, but it is producer price index is still an important inflationary data point, except the reason it's not as much of a focal point when it comes to inflation is because at the manufacturing level, not all cost increases get passed along to the consumer. So let's say you're a manufacturing company and the cost of producing your products or goods and services goes up by 8%. You're not necessarily going to pass that entire 8% increase onto the consumer. You say, you know what? If we pass that 8% onto the consumer, we may lose revenues, we may lose sales. So we're gonna eat 2% and we're gonna pass 6% onto the consumer. And so producer price index isn't as solid of an indicator on inflation because it doesn't tell us the end user increase in cost like CPI, consumer price index, does. So producer price index comes out tomorrow. We also get jobless claims tomorrow, again, initial and continuing jobless claims. So we'll keep an eye on that. And I'll post that in the Powerhouse Real Estate group. So keep an eye out for that. And if you have any questions about any of the economic data, the direction that we're moving in the mortgage markets, please reach out. You've got my contact information right here. You can make comments on the Facebook page in the post below. But I'm going to leave you with this. I want to share this with you real quick. I'm going to pull up the mortgage bond or mortgage-backed security charting that's going on right now today. So here we are. This is the 30-year 3% mortgage-backed security coupon. And so the main point that I want to make here is you can see this series of red bars that basically started on January 5th. And we've had nothing but downward movement in mortgage-backed securities. And you've heard me say this before, but mortgage-backed securities, mortgage bonds, as we call them, they have an inverse relationship with interest rates. So as mortgage bond prices decline, interest rates climb. And so we've seen a healthy amount of decline in mortgage bonds over the last week and a half. I mean, really, you had a small green day here, but another red day. So, 6 out of the last 7 days. Today, we were green for a little bit. Looks like we're on the verge of turning this into a red day in mortgage bonds. So we've had significant downward movement in mortgage bond prices, and that's been driving interest rates up. So the refinance volume has dropped dramatically. We've seen about a 50% decrease in refinance volume, as you would expect in a rising rate environment. Purchases are still looking pretty solid. That market is always going to be there, but as interest rates rise, it erodes affordability. And with home prices rising at such a dramatic clip, and with interest rates rising, it's really putting a squeeze on affordability. So if you're a home buyer and you've been looking in that $250,000, $350,000 range, you're seeing your purchase power shrink a little bit. And as a real estate agent, if that's you, you're obviously seeing the ability of your buyers become harder and harder in this market. So it's more important than ever to make sure that you've got the right strategy, you've got a plan in place, and you're having those really deep, important conversations with your clients to ensure that they are in the right mindset for our current market. So with that being said, again, if there's any questions that you have, don't hesitate to reach out to me at my contact information below. I'm happy to answer any questions that you have. I'm Sean Richard with the Sean Richard Mortgage Team. Thank you so much for joining in on this episode of SRT Live, and I'll be back in touch on Friday in the Powerhouse Real Estate Group with, I'll be talking about ATMs. And yes, the ATMs that I'm going to be talking about also spit out money, but not what you're thinking. So have an incredible rest of your day, and I'll catch up with you on Friday. Thanks so much.